Let's take a look at an example, and this is from the lessee's perspective. The Krusty Krab leases its restaurant furniture. A lease agreement signed on January 1st, 2026 requires the company to pay $50,000 annually, and in this case, it's at the end of the year. The leases that we're going to look at are either going to have the first payment made at the beginning of the year, which is probably more common in practice, or at the end of the year, as in this case. The lease term is for 3 years, and I made it a short lease so that we could see exactly what happens with the cash flows and the journal entries across the full 3 years. The interest rate on the lease, what we're going to use to determine the time value of money, is 7%. On the date of the lease, the equipment has a fair value of $135,000 and an estimated useful life of 4 years. A asks us to determine the present value of the lease. So what we're saying here, remember your principles of time value of money. What we want to do is look at the payment. There's going to be 3 cash payments. One is a $50,000 1 year from now. So if we want to discount that back to today, we need to divide it by 1 plus the interest rate. So $50,000 divided by 1 plus the interest rate. And then that second payment at the end of 2 years is going to be discounted back 2 years. 1 plus the interest rate, 1.07 squared. And we're going to add to that 50,000 discounted back 3 years. Now, we don't need to actually do all of this out. One thing we can do is use Excel and say, take the present value, interest rate of 7%, 3 periods, the payment is 50,000, the value at the end of the lease is 0, and the payments are made at the end of the year. And that will get us $131,216. Now, another way that we could get this number is by using present value of an annuity factor. And so you'll see in Connect we have these links to tables. Because the amount is due at the end of the year, we want the present value of an annuity as opposed to the annuity due. Annuity due is when the first payment is made at the beginning of the year. We want present value of an annuity. The number of periods is 3, and I'm going to go down to 7%, and I see my present value factor is 2.62432. And what I would do here is multiply that present value factor by the payments. And that's going to get me $131,216. So that's how we determine the present value of the lease on the first day. Determine whether the lease qualifies as a finance lease. So here is A. This is the present value. And B, we don't know anything about a bargain purchase option, transfer of ownership at the end, or customizable. Let's assume none of those exist. Let's look at the lease term. The lease term is for 3 years out of 4 years, and we've met our criteria for the finance lease. If we wanted to, we could also have said, what about those lease payments? $131,216. It doesn't matter, even if it fails this test, it's still a finance lease. Out of the total fair value of $135,000, clearly that's going to be over 90%. Okay, so this is definitely a finance lease. And what we're going to do is walk through the journal entries for a finance lease. Record the company's journal entry on January 1st, 2026. What we need to do now is, where the lessee, record this lease. We're going to debit to increase the asset right of use. And that's going to be at the present value of those lease payments, $131,216. And we're going to add on the liability to the books, add lease payable. This is a liability account at the present value of those future lease payments. Before I go on to the lease amortization, I want to note a couple of things that are going to happen. For a finance lease, When the cash payment is made, some of that cash payment is going to relate to interest, and some of it is going to relate to principal. And the portion that's interest, we need to remember the formula for interest expense. And it's going to look very similar to our interest expense when we use the effective interest method, when we were looking for investments, or on the other side of it, when we were looking for a bond that was issued at a discount. We're going to take the beginning, where we said carrying value of a bond. Now we're saying the beginning balance in the lease payable. What is the outstanding liability amount? And let's multiply that by the interest rate on the lease. And in this case, we said that it was going to be 7%. Okay, so we want to memorize this formula. And then the reduction, so we have our cash payment of $50,000. Some of that is going to be interest expense. That's going to change every year because the rest of that cash payment goes to the reduction of the lease liability or the lease payable. We take the cash lease payment amount minus the portion that relates to interest expense. And that's the amount by which we reduce our lease payable. Okay, so we want to memorize these formulas. And this is going to help us when we solve for what's being asked here in D, prepare a lease amortization schedule. And what that's going to do is show the amount of interest expense for each period. So we have our date, we have our lease payment amount. That's always going to be $50,000. Lease payments are typically the same every month. Some portion is interest expense. We know because we have our formula there, we're going to use that. Some of this is going to relate to the amount of principal repayment. And the amount of our principal payment is going to help us determine the ending balance in the lease payable account. Okay, so let's start simply with the day the loan or the lease originates. Call that the commencement date of the lease. Present value is 1/31/2016. Okay, the first payment is going to be made at the end of the year, and that lease payment is going to be $50,000. So some of that lease payment is going to be interest expense, and the rest of it is going to be repayment of principal. How much is interest expense? Take the beginning balance in the loan, in the lease payable, 1/31/2016, and multiply it by the interest rate on this lease, which is 7%. And that is going to give us $9,185. Okay, so of our $50,000 lease payment, $9,185 is interest expense, and the rest is the portion that we are paying off of our lease liability. This is exactly the same way my mortgage works, or car loans, car financing would work. This works out to be $40,815. Okay, so what's the ending balance in our lease payable? It was 1/31/2016, and then we reduced it by $40,815. And so our ending balance in the lease payable, the end of the first year, is $90,401. We follow the same method for the next 2 years in our final 2 payments. $50,000, now our beginning balance in the loan is $90,401. We've paid some of it off, so our interest expense is going to be lower. Multiply that by 7%, and our interest expense for 2027, $6,328. It should make sense that our interest expense is lower because the amount that we're assumed borrowing has decreased. How much of our $50,000 lease payment relates to repaying principal? Back out the portion that relates to interest, and the rest relates to principal repayment. We've reduced our loan principal $94,001 by the $43,672. So at the end of the second year, our remaining balance is $46,729. We make one more lease payment, the end of 2028. Our beginning loan balance, our lease liability balance, 46,729. Multiply that by 7%. I get 3,271. The portion that I'm repaying of principal is 46,000. So this might come out a dollar difference due to rounding. Let's just say it's 46,729, and that's exactly what I want it to be. My balance was 46,729. Of my 50,000, I'm repaying that full amount, and my ending lease payable balance at the end of the 3-year lease term is 0. That's our lease amortization schedule. The next thing we want to do is record the journal entries. In 2026, so we put the asset and the liability on the books. I'm going to make some T accounts so I can track the balances. In the right of use asset, 1/126, we added 131,216. And I'm going to create a T account for my lease payable, my lease liability account. And I'm going to see how the balances change over time. Okay, so we already recorded the journal entry to put on the asset and the liability. Then what happens? We have entries on December 31st, 2026, the end of the first year. So one entry is going to be to have the cash payment. So I'm going to have 2 debits, leave 2 lines here. I'm going to credit cash 50,000. I like to put my most obvious accounts first. I have interest expense, time passed. There's a time value of money component here. My amount of interest expense, remember we did it on the amortization table. We can just take the numbers from there. 7% of the beginning balance. The balance in that loan, in that lease payable, is 131,216. So my interest expense, remember, was 9,185, and I'm going to debit to reduce the balance in the lease payable account for the difference. This is my plug number. Okay, so I'm going to show on my T account that I just reduced my lease payable on 12/31/2026. So this is my adjusting entry, or I guess there's a cash payment, so it's not completely an adjusting entry. What is my balance that I'm going to show on the balance sheet? 131,216 minus 48,15. I'm going to have a balance now, a credit balance in my lease payable account of 90,401. This is what's going to be reported on the balance sheet as a liability. But I'm not done. I need one more entry on 12/31/2026. I still show my asset, 131,216. I need to reduce that asset. We're going to amortize. Remember, to reduce the right of use asset, we record amortization expense. It's just like depreciation expense, except it just goes by a different name. We're going to use straight line. Take that initial amount and divide it across, allocate it across the 3 years. The amortization expense works out to be 43,739. The other side of that entry, I'm not going to use a contra asset. I'm going to directly decrease the right of use asset. 43,739. Okay, I'm going to plug this into my T account, reduce the asset by 43,739. And now I have a balance that I'm going to report on my balance sheet of 87,477. This is going to go on the balance sheet. And that's what we're asked to do is, after these entries are recorded, what's reported on the balance sheet? 12/31/26. And then what is the year ended 12/31/26 income statement going to show? We're going to have the right of use asset with a balance of 87477. And we're going to report the lease liability, the lease payable. Typically, this is going to be called lease liability. We're calling it lease payable, 90,401. And what is going to appear on the income statement related to the lease? We're going to report amortization expense. This will be in the operating section typically. And we'll have interest expense in the non-operating section. And these are coming directly from my journal entries. Okay, time goes on. The next year goes on, and we need entries 12/31/27. One entry is going to be for the cash payment, credit cash, 50,000. I'm going to record interest expense. The dollar amount will change because what's the beginning balance in my lease liability? 90,401, what I reported on the balance sheet at the end of last year. So interest expense is 6,328. And then the difference between the cash payment and the portion that relates to interest is the portion that I'm reducing that lease payable. And that works out to be 43,672. So I want to include this reduction in the lease payable in my T account. I'm going to debit to reduce lease payable 43,672. So my balance in the lease payable account is going to be 46,729. And then my amortization expense is going to be exactly the same as what we recorded the prior year, straight line amortization, so 43,739. Directly reduce the right of use asset, 43,739. I'm going to post that journal entry to my ledger. I'm going to decrease the asset, 43,739. And that's going to give me an ending balance, the end of 2027, of 43,739. That's what it should be because this is my last year. I've allocated this total ROU asset evenly across the 3 years. I know what my next year's amortization is going to be, and that's going to get me down to 0. So after these entries are recorded, what's going to be reported on the balance sheet and on the income statement? We're going to have a right of use asset, we said the balance was 43,739, and we have the lease payable. We said the balance in the lease payable was 46,729. For the income statement for the year 2027, we're going to have amortization expense, same amount every year, and we're also going to report interest expense, which will change each year. For 2027, the interest expense was 6,328. This takes us to our very last year. We need to record our journal entries on 12/31/2028. One more entry for our last cash payment of 50,000. debit to increase interest expense. Take the beginning value of the lease payable, 46,729, times 7%. Interest expense in this last year, 3,271. Reduce our lease payable account. And I know what the balance is in the lease payable, 46,729. This should work out to be that same amount, or maybe off by $1, just simply due to rounding. And this comes out to be 46,729, exactly what we wanted. When I post this reduction in the lease liability, debit of 46, it's my ending balance last year. Now I'm going to post a debit of 46,729, and on 12/31/28, my ending balance is going to be 0. That's exactly what I want. It's the end of the lease term. I need to record my last amortization on that right of use asset. And post this entry. This is my balance. And it's exactly what we want. The end of the 3 years, we have no remaining asset balance, no remaining lease payable balance. So what we have on the balance sheet is nothing. And what we record on the income statement is amortization expense, as we have, and interest expense in that last year of 3,271.